is a senior economist at CIBC Capital Markets. With us now, Royce, always good to have you. And there's so much to chew on and so little to be clear about, which of course makes it hard for economists to do their forecasting. But just in terms of where you think we stand and the ability for the economy to be resilient in fourth quarter, that seems to be the big question, the big point of uncertainty.
Yeah, that's the huge problem with this survey, actually, is that it was done at the beginning of September, which I would argue was the best time for the Canadian economy since February. Now the clouds have darkened. We can see parts of the economy are being shut down. Virus case counts are rising again. So what is it that we can take from this survey? Maybe very little. And when I look through the details of the survey, even in early September, it seemed like businesses were in a whole lot of trouble. There's weakness across categories. Yes, there were rebounds from the lows in the prior survey, but you look at things like employment, capital spending intentions, the ability to raise prices, all of that looked pretty weak in the context of an economy that was supposed to be rebounding pretty quickly at that time.
So when you think about where we do go from here, we do, of course, unlike the U.S., we have a little more certainty about the kind of fiscal support businesses and individuals can count on. Is it possible to extrapolate from that what you might be able to kind of carry forward, even in the face of those darkening clouds around COVID and new restrictions in certain areas and things that might worsen in the next weeks?
Well, let's say we can keep the restrictions just to what we have right now. So a few services, we're talking about indoor dining, we're talking about gyms, things like that. Big sporting events, we're not going to get back. Conference center activity, we're not going to get back. Those types of things, then we would lose, far less GDP than we did the first time we saw a very broad-based shutdown. At this point, it is great that we have more certainty than the U.S. in terms of the stance of fiscal policy here. We can see into the future that households and individuals that have lost employment due to the pandemic will have a safety net. The problem is it may not be enough to sustain spending moving into the winter months. I would argue that the most powerful stimulus we could get right now is a boost to consumer confidence. We saw, I think, for the third consecutive week, the Bloomberg Nanos Index decline. That's an index of consumer confidence, of course. If we have people who are unwilling to go out and spend their money, it's going to hurt the economy. Usually, economists argue about how to boost consumer confidence. But this time, we have a clear answer. We know what the answer is. Get the virus under control, and consumer confidence will bounce back. We've seen savings accounts at banks, personal savings accounts at banks, increase in the tens of billions to hundreds of billions of dollars. People who were fortunate enough not to lose employment during the pandemic, and actually by staying at home saved some money, have piled up cash in their bank accounts. That can be used if consumer confidence is able to rebound in the months ahead.
And I guess one factor that might play into that, which showed up in the survey, is expectations on wages. I think there was a sense that wage expectations would slow. We do see that. What do you make of that, and what might that do?
Well, overall, we've seen an issue with wages in developed economies, right? We've seen bargaining power decrease. We've seen automation, globalization reduce the power of labor versus the power of capital in negotiations over wages. The pandemic completely threw a curveball here because we have seen a massive drop in employment. Now, to get wages going, you usually need a pretty tight labor market, which from our standpoint, we're not forecasting that for years into the future to see a labor market anything like what we saw in February. So we should expect that type of wage increases, which would push sort of consumption along with it or pull consumption along with it or household spending, we aren't going to see materialize. So we have to basically expect right now what the best we can hope for is that people start spending the money they have or are getting in their income. That's what we can hope for. If we can't even do that, we'll be in a pretty tough spot this winter and heading into the spring next year.
Royce, when you say, one of the biggest factors will be resolving the pandemic, the path of the pandemic, how you manage the pandemic in your country will be a big determinant, right? And how businesses can operate, how people can move about. How problematic is it that Canada does not seem to have done a very good job on testing, on tracing? And I say that not to be needlessly critical of the federal government or provincial governments, but just compared to other jurisdictions. We seem to be behind other jurisdictions on this front.
I'll just make a point about how much we're losing at the moment. We're not only losing the numbers that I can calculate in GDP. As we know, GDP doesn't capture everything in everyone's lives. There is a lot more at stake here that is being lost during these pandemic times. So putting money into things like testing and tracing and getting the virus under wraps not only builds back all those dollars and cents that show up in the Statistics Canada's GDP reports, but it builds back people's livelihoods and people's businesses. And that is incredibly important. And that could add up to hundreds and hundreds of billions of dollars that are not calculated in GDP. Look, I saw a study out of the US. It tried to quantify those types of things, people's health, people's mental health, physical health, death rates. It came up with a number of $16 trillion. The U.S. economy is $20 trillion. That's how much the pandemic has cost the U.S. Over and above the GDP losses that we're losing, there's a lot more at stake here. So as you say, getting testing, tracing, all of the health stuff right would really do a lot to boost the economy, better than any proposal for a stimulus program that any economist can come up with.
Meanwhile, of course, we seem to be going the other direction with, another region added to phase 2 restrictions in Ontario, Winnipeg doing worse than it had done previously, other places across the country, Quebec especially, kind of on a runaway tear with COVID. Is it getting to be too late for damage in the next few months? Or do we need to start looking into 2021, Royce, to feel like we can get past whatever this next hurdle will be?
We're trying to work all that out in our models. We actually found out that September looked a little bit better. We saw a blockbuster job gain in that month, much more than we had anticipated. So we actually get a little bit of help from a more favorable starting point, but we have to probably downgrade these months. The second wave in Canada showed up a little bit earlier than we had expected. So, I think the fall and winter are going to be critical. Everyone's going to have a base case forecast that I would argue is going to look more dire than it did a month, 2 months, 3 months ago for the fall and winter because of what the types of increases in new virus cases that you mentioned. The question is, can we limit the damage to just that? Because, of course, as we know, the downside risks are tremendous here, but the upside risk, usually we talk about a balance of risks around scenarios. There's no balance of risk here. The upside is that, maybe we can open a few more little parts of the economy. But, people aren't going to be going en masse on vacation on airlines again until there's a vaccine. People aren't going to be going to conferences in large groups until there is a vaccine. All of those businesses are still shut. So what we need to do right now is focus on getting the virus under control and limit that downside to the economy because there is a very asymmetrical risk over the next 3 to 6 months here for the Canadian economy.